Imagine Sarah, a diligent professional, contributing $5,000 to her IRA last year. She believed this move, a smart tax deduction, would significantly slash her tax bill. Her expectation? A direct $5,000 reduction in what she owed the IRS. Yet, when her tax return was filed, the actual savings were closer to $1,200. This disparity, a common point of confusion for millions, forms the core of our investigation today. What explains this unexpected outcome? The answer lies in a fundamental, yet often misunderstood, difference in tax mechanics, the distinction between a deduction and a credit. Before we dissect Sarah's puzzling situation, let's establish a foundational understanding. Tax relief, in its broadest sense, refers to provisions designed to lower a taxpayer's overall tax burden. This can manifest in various forms, from exemptions to exclusions. However, deductions and credits are arguably the most impactful and widely utilized mechanisms for reducing tax owed. They are often conflated, leading to miscalculations and missed opportunities. Our inquiry begins with understanding their distinct operational frameworks, starting with the one many perceive as simpler, the deduction. A tax deduction, at its core, reduces your taxable income. This is the amount of your earnings that the government actually applies tax rates to. Think of it as shrinking the pie before the slices are cut. For instance, if you earn $60,000 and qualify for $5,000 in deductions, your taxable income becomes $55,000, not $60,000. This crucial step happens above the line on your tax return, influencing your adjusted gross income, or AGI, which in turn affects eligibility for other tax benefits. This is a key insight from IRS publications. The true impact of a deduction is determined by your marginal tax bracket. The U.S. tax system is progressive, meaning different portions of your income are taxed at different rates. For example, if you're in the 24% tax bracket, every dollar of deduction you claim reduces your taxable income by $1, which in turn reduces your tax liability by 24 cents. As financial economists often highlight, this means a $1,000 deduction saves you $240, not $1,000. This is the mechanism that clarifies Sarah's initial confusion. Revisiting Sarah's $5,000 IRA deduction, if we assume her highest income was taxed at the 24% marginal rate, the math becomes clear. A $5,000 deduction, multiplied by her 24% marginal rate, indeed yields a $1,200 reduction in her tax bill. This is a significant saving, but demonstrably not a dollar-for-dollar cut from her final tax liability. This scenario, common among diligent savers, underscores a prevalent misconception that a deduction functions as a direct reduction of tax owed. Our investigation finds this to be a primary source of taxpayer surprise. Deductions are woven into many aspects of everyday life. For instance, the interest paid on student loans, contributions to a health savings account, or certain medical expenses exceeding a specific percentage of your adjusted gross income can all be deducted. Homeowners often benefit from the mortgage interest deduction. These are not obscure provisions, they are integral parts of the tax code, designed to incentivize specific behaviors or alleviate financial burdens. Understanding which ones apply to you is the first step towards informed tax planning, as financial advisors routinely advise. Most taxpayers face a critical decision: take the standard deduction or itemize their deductions. The standard deduction is a fixed amount set by the IRS, varying by filing status. For instance, in a hypothetical year, it might be around $14,600 for single filers. If your total itemized deductions, like mortgage interest, state and local taxes, or charitable contributions, exceed this standard amount, you itemize. Otherwise, the standard deduction is often the simpler and more beneficial choice. This choice directly impacts how much income is subject to taxation. While not dollar-for-dollar tax savings, deductions remain a powerful tool, particularly for higher income earners. A taxpayer in the 35% bracket, for example, will see a $1,000 deduction reduce their tax bill by $350. The same deduction for someone in the 12% bracket saves only $120. This progressive impact means deductions disproportionately benefit those with higher taxable incomes. Understanding this marginal benefit is crucial for strategic tax planning and maximizing the effectiveness of every dollar saved or spent, as tax analysts frequently emphasize. Now, let's pivot to the second key mechanism, tax credits. Unlike deductions, which reduce your taxable income, a tax credit directly reduces your tax liability, the actual amount of tax you owe the government. This is a crucial distinction. If you owe $1,000 in taxes and qualify for a $500 tax credit, your tax bill is immediately reduced to $500. It's a dollar-for-dollar reduction from the final amount, a stark contrast to deductions. This direct impact is what makes credits particularly potent, as clarified by IRS instructional guides. The primary advantage of a tax credit is its dollar-for-dollar impact. A $1,000 tax credit means your tax bill drops by exactly $1,000. This makes credits incredibly valuable, often more so than an equivalent deduction, especially for those in lower tax brackets. While a $1,000 deduction might save a 12% bracket taxpayer only $120, a $1,000 credit saves them the full $1,000. This directness is a key factor in why policymakers often use credits to achieve specific economic or social goals, as noted in analyses of federal budget policy. Many widely utilized tax credits aim to support specific demographics or encourage certain activities. The child tax credit, for example, is a significant benefit for families with children. Education credits, such as the American Opportunity Tax Credit or Lifetime Learning Credit, support students and their families. Credits for energy-efficient home improvements, like installing solar panels, incentivize environmental responsibility. These credits are not merely financial tools, they reflect broader governmental objectives and can represent substantial financial assistance, particularly for those meeting specific criteria. Here lies perhaps the most crucial moment in understanding tax credits, the distinction between refundable and non-refundable credits. Many taxpayers mistakenly assume all credits are the same, but their refundability changes everything. A non-refundable credit can reduce your tax liability to zero, but no further. If you owe $500 and have a $1,000 non-refundable credit, you'll pay $0 in taxes, and the remaining $500 credit is simply lost. A refundable credit, however, can result in a direct payment to you, even if you owe no tax. This difference is paramount. Non-refundable credits, while valuable, have a ceiling. They can reduce your tax liability down to zero, meaning you pay nothing. But if the credit amount exceeds your tax liability, the excess amount is not given back to you as a refund. For example, if you owe $800 in taxes and have a $1,000 non-refundable credit, your tax bill becomes $0. The extra $200 from the credit simply vanishes. This means that taxpayers with very low tax liabilities might not receive the full benefit of certain non-refundable credits, a point often overlooked. Refundable credits operate under a different set of rules entirely. If a refundable credit exceeds your tax liability, the government sends you the difference as a tax refund. Consider a family with no tax liability, but eligible for a $2,000 refundable credit. They would receive a check for $2,000. This is how many low-income families receive substantial financial assistance from the tax system. The Earned Income Tax Credit, EITC, is a prime example of a refundable credit, demonstrably providing millions of dollars in direct aid annually, according to Treasury data. The Earned Income Tax Credit, or EITC, stands as one of the most significant refundable credits. Designed to help low to moderate income working individuals and families, its value can vary significantly based on income, filing status, and number of qualifying children. For an illustrative family with 3 or more children, the EITC can be substantial, potentially exceeding $7,000 in a given tax year. This credit directly puts money back into the pockets of families, stimulating local economies and reducing poverty, as economic studies consistently show. A significant misconception our investigation uncovers is the belief that all tax credits offer the same dollar-back promise. Many taxpayers see credit and automatically assume it's fully refundable. This is a critical error. The actual classification, refundable or non-refundable, is paramount. Failing to differentiate can lead to disappointment, as potential refunds might not materialize, or credits might be left on the table. It's imperative to understand the specific nature of each credit you might be eligible for, a distinction tax preparers emphasize daily. Let's conduct a direct comparison. Consider a taxpayer in the 22% bracket with a $1,000 deduction versus a $1,000 non-refundable credit. The $1,000 deduction reduces taxable income by $1,000, saving $220 in taxes, $1,000 * 22%. The $1,000 non-refundable credit directly reduces the tax bill by $1,000, assuming there's at least $1,000 in tax liability. Even for the same dollar value, the credit consistently provides greater tax relief for most taxpayers. This disparity highlights why credits are generally considered more beneficial by tax policy experts. The difference becomes even more pronounced for lower-income taxpayers with minimal tax liability. Imagine a single parent with $15,000 taxable income, potentially in the 10% tax bracket, and eligible for both a $1,000 deduction and a $1,000 refundable credit. The $1,000 deduction would save them only $100, $1,000 * 10%. However, the $1,000 refundable credit, even if their tax liability was, say, $500, would not only wipe out that $500 but also result in a $500 direct refund. This is the ultimate wait, really, moment, the government paying you. Consider a young family, the Millers, with 2 children and a combined income of $70,000. They have $3,000 in student loan interest, a deduction, and are eligible for the child tax credit, a non-refundable credit, and potentially a child care credit, also often non-refundable. The $3,000 deduction, in their 12% marginal bracket, saves them $360. However, the child tax credit of, say, $4,000 for 2 children, would directly reduce their tax bill by $4,000, assuming they have that much liability. This clearly illustrates which mechanism offers immediate, greater relief. For homeowners, deductions and credits intertwine. The mortgage interest deduction is a significant itemized deduction for many, reducing taxable income. But consider a homeowner installing solar panels, often eligible for a substantial clean energy tax credit. This credit, typically non-refundable, directly lowers the tax bill by a percentage of the installation cost, for example, 30% of $20,000, equating to a $6,000 credit. This could effectively zero out their tax liability, while the mortgage deduction only offers a percentage saving based on their bracket. Strategic choices become clear. Adjusted gross income, or AGI, plays a silent but crucial role in the interplay of deductions and credits. Deductions, like IRA contributions or student loan interest, reduce your income before AGI is calculated. A lower AGI can be highly beneficial, as eligibility for many other tax breaks, certain credits, and even medical expense thresholds are often tied to your AGI. Credits, conversely, often come into play after AGI is established, directly affecting the final tax bill. Understanding this sequence is vital for maximizing your overall tax efficiency. Often, the language around deductions and credits is muddled with terms like tax loopholes, implying something illicit or unfair. Our investigation finds these provisions are deliberately enacted by Congress, not loopholes. Deductions incentivize savings, homeownership, or education. Credits support families, promote specific investments, or assist low-income workers. They are tools of fiscal policy, transparently outlined in IRS code. The confusion arises from a lack of clear understanding of their mechanics, not from their hidden nature, as government accountability reports routinely confirm. An informed taxpayer views deductions and credits as essential components of their financial toolkit. They understand that while both reduce tax burdens, they do so through fundamentally different pathways with varying degrees of impact. Maximizing deductions when itemizing, strategically contributing to tax-advantaged accounts like IRAs, and rigorously identifying all eligible credits, especially refundable ones, can collectively optimize your tax outcome. It's about more than just filling out forms, it's about understanding the system to your advantage, a core tenet of sound personal finance. There are specific instances where a deduction might feel more impactful than a credit of similar nominal value, even if the math says otherwise. For very high-income earners in top tax brackets, a substantial deduction can free up a considerable amount of taxable income that would otherwise be taxed at their highest marginal rate. This psychological perception, however, does not alter the fundamental mechanism. A credit still offers a dollar-for-dollar reduction from the final tax bill, while a deduction offers a percentage. The directness of the credit remains its inherent strength. Our analysis reveals several common pitfalls taxpayers encounter. First, failing to keep meticulous records for itemized deductions. Second, overlooking eligibility for credits, especially lesser-known ones, simply because they don't immediately appear obvious. Third, mistaking non-refundable credits for refundable ones, leading to disappointment at tax time. A rigorous approach involves actively researching potential deductions and credits, maintaining organized financial records, and if uncertain, seeking professional guidance. These steps are frequently cited by tax agencies as crucial for compliance and maximum benefit. Modern tax software aims to simplify this complex landscape, guiding users through potential deductions and credits. However, even the most sophisticated software relies on the information you provide. If you're unaware of certain expenses that qualify as deductions or circumstances that make you eligible for credits, the software can't magically find them. This underscores the necessity of foundational knowledge. Software is a tool. Understanding the difference between deductions and credits is the manual that allows you to use that tool effectively, a point often stressed by financial tech experts. Beyond individual savings, deductions and credits serve broader economic purposes. Deductions for business expenses encourage entrepreneurship and investment. Credits for energy-efficient vehicles or home improvements drive green initiatives. The child tax credit supports family stability and child well-being, potentially boosting consumer spending. These provisions are not merely line items on a tax form, they are levers of economic policy, shaping market behavior, influencing social outcomes, and impacting trillions of dollars annually across the national economy, as detailed by the Congressional Budget Office. Let's return to Sarah. Her $5,000 IRA deduction, while saving her $1,200, operated exactly as designed, reducing her taxable income. If Sarah had instead been eligible for a $5,000 refundable tax credit, for instance, a hypothetical housing stability credit, her tax bill might have been entirely wiped out, and she could have received a direct refund for any excess. This thought experiment vividly illustrates the practical difference. Sarah's initial disappointment stemmed not from a flaw in the system, but from a common misunderstanding of its fundamental mechanics. The journey through deductions and credits reveals a critical truth: understanding these distinctions empowers you. It moves you from passively accepting your tax outcome to actively shaping it. Knowing how deductions lower taxable income versus how credits directly cut your tax liability, and especially discerning between refundable and non-refundable credits, is not mere trivia. It's financial intelligence that can translate into hundreds, even thousands, of dollars saved or received. This intelligence is the foundation of effective financial management, as widely acknowledged by consumer finance advocates. In summary, the core difference is this: deductions reduce the amount of income subject to tax, saving you a percentage based on your marginal tax rate. Credits reduce your actual tax bill, dollar for dollar. And within credits, the distinction between refundable and non-refundable is paramount, determining if an excess credit can be paid back to you. This fundamental separation is not just semantic, it dictates the true monetary value of each tax break. Our investigation concludes that this distinction is the single most important concept for taxpayers to grasp. So, what are your next steps? Don't just file your taxes, understand them. Review your income and expenses to identify all potential deductions. Research credits that might apply to your family situation, education pursuits, or home improvements, paying close attention to their refundability. Consult reputable sources like irs.gov or a qualified tax professional. The knowledge gained from this deep dive is a powerful asset. Use it to optimize your financial well-being and confidently navigate the complexities of the tax system.